Good morning, Ricky. Good morning, Dollar. It's been a pleasure thus far working with you guys in reference to your retirement goals. The reason for this meeting this morning is to touch base on what we had our conversation previously. I want to first start off with some of the information you guys relayed to me in reference to your goals, starting first with your retirement goal. Ricky, looks like you want to retire at 65, and Dollar, you want to retire the same year as Ricky, and at that point you will be 68. The amount of money you guys will need to cover your general expenses was roughly about $100,000. You both had a few wants. First, traveling every 2 years, which is wonderful. 10,000 per trip that you're looking to do. Also, you guys both had a request in reference to your vehicles. Trading in your vehicles, you Ricky at 20,000 and you Darla at 30,000. Basically recurring every 4 years for you Ricky and recurring every 3 years for you Darla. And then also you want to leave a bequest to Corby. You want to leave roughly about $50,000 to him once you guys are unfortunately gone, passed away. So I'm glad to kind of take a look at that for you. And now I want to take a look at your assets. Essentially, your net worth right now is 1,165,000, which included in the asset balance is 965,000, and then your other assets would basically be your property and your home, roughly about $200,000. So as it stands as of today, 1,165,000 is your current net worth. So comprised now is your current portfolio. Right now, currently, it's about 63% of it is invested into your stocks, and you yielding roughly 7.88%. Now, if you look closely, during the 2007 November to February 2009, there was a recession loss. So, as your portfolio stands currently constructed, you have roughly about 28% loss, equating to $269,740. So even though it was at loss, your portfolio actually yielded decently throughout that tough time period for a lot of different people. So really good about how your portfolio is as it's constructed as it is now. Next, we're going to take a look at it's called the efficient frontier. The reason why we want to take a look at this is the relationship versus risk and return. So simply putting, there's so much risk that you guys are willing to take, what you guys mentioned to me earlier about how much risk you're looking to take on that will yield a certain portfolio. As you can take a look here, it just shows some various models of different ideas basically for different portfolios. And your portfolio, your current portfolio right now has a risk deviation or standard deviation of roughly about 11%, yielding a little over 7% in return. If you want to get the actual number, your risk is 11.06%, and your return actually is a 7.88%. So you guys are yielding a risk factor of 11% that gives you back a return of 7.88%. And now we're going to take a look at what's called the Monte Carlo simulation. So the future is unpredictable. We want to make that abundantly clear. Nobody can accurately predict what's going to take place in the future, but to eliminate all of the unknown factors that come from day-to-day living, the Monte Carlo simulation helps out with that. It gives us the opportunity to input different random variables that can possibly take place in the future. That way we can more accurately predict some scenarios for you. So with this current depiction, was able to run 1,000 trials to get various possibilities of what can transpire with how your current portfolio is constructed and yielding some different various amounts in terms of what the value of your portfolio is. Now, as you can see, the confidence level is above our recommended zone, currently at 99%. Probability of success for it, which is above the ideal recommended amount, which is roughly in between 80 to 85%. And what we will do now is take a look at your current construction of your portfolio and take a look at some things that I would recommend for you to do, for you, Darla, and you, Ricky, to kind of do to help meet all of your wants and wishes for your retirement goal. Okay, now we're going to take a look at how your current portfolio um, kind of compares against the recommended portfolios that I constructed for you. So we can take a look at the various confidence zones for each one. As you can see, yours is still at the 99%. The recommendation I have for you are if you guys retire a little bit earlier, you have a 4% chance of achieving all of your goals. Another one will be if you increase your living expenses, increase your travel expenses, and also increase the bequest to Corby, you'll also have an 83% chance of completing that goal. And then lastly will be what's called our super solve. It, so to speak, takes some of the criteria we have. We can lock certain things in terms of living expenses or the bequests, and it comes up with a recommended portfolio for you guys as well, which that equates to 81%. Let's take a little bit of details of the numbers for you here. So, spending wise for the plans will be yours currently is be 3,220,000 over the life of your plan. Within the recommended plan that I have for you, it'd be roughly about 3,850,000. For the increased living, travel, and bequest expenses, it'd be 4,230,000. If we decide to go with the super solve method, it'd be 4,181,250,000. Let's take a look at some of the key changes. As you can see, the portfolio consists of the same. They're both based off the total return tool, which you will see that 7.28%, 12.12%, and then 4.91% will be adjusted real return compared to your 7.88, 11.06 in terms of the risk factor, and then the adjusted real return. Now, in terms of the retiring early, currently, Ricky, you want to retire at $65.68. Proposed will be Ricky, you retiring at 59, and Dollar, you return at 62. Now, your living expenses will still be the same if you do the first recommended change at 100,000. If you decide to go with the increased living expenses, your retirement age stays the same, but what changes is the amount, which should be 125,000. Now, Super Solve, it still has you at same retirement age, but you're looking at about $106,250 for your new expenses that you would do during your retirement. Now, as it pertains to traveling costs, with the early retirement, you're still looking at the same 10,000 for every 2 years. Now, if you go with the increased travel, it'll be roughly 30,000 when you both are retired for your traveling every 2 years. And same thing with the super solve. You're looking at roughly $31,250 for that for every 2 years. Now, as it pertains to you guys' vehicles, we retired early, the information stays the same. Same with the increased travel requests and also the increased expenses. It's 20,000, 30,000 respectively. Now, what does change for Super Solve is you're looking at Ricky. You're looking at a bigger truck, bigger vehicle. $62,500 as well, 93,750. So if you guys are looking for something super, super, super fancy and something that's like woo, then yes, that amount there can get you something relatively really really good. And lastly, it's the bequest. So the bequest is for Corby. You know, you want to leave him something. You know, you guys wanted 50,000. Well, the good news is with the early retirement, you'll still be able to do your 50,000. Now, the bequest will now increase to 80,000 for him if you go with the increased expenses, travel, and bequest. And then with Super Solve, we look at roughly the same amount for that bequest for corporate. So as you can see, as constructed, there are some very good recommendations for you guys with very good success rates for you. The personal one that I recommend for you, of course, will just be retiring early. As that stands, you can keep everything the same in terms of the amount you want to live through retirement, your traveling costs, your vehicle costs, as well as the bequest. The only thing that instead of you retiring at 65, Ricky, you just be retiring at 59. So, and then same with you, dog. Instead of 68, you're looking at 62. So you're enjoying things a little bit earlier than anticipated. So it's nothing bad for retiring just a little bit earlier. And finally, Ricky and Darla, I just wanted to touch base on the last thing. It's basically these charts here. It shows just the recommendation that I have for you guys for early retirement. Kind of shows the projection of how things gonna transpire over that time frame during your retirement, starting with the year that you first retirement and on to the end of the plan. So it also shows in terms of your asset balances, taxable assets. And if you look closely at the bottom here, it goes over the returns for your profile, the returns for your portfolio, balances for your portfolio as well. And it shows the point when you guys do retire at 59.62 respectively. Shows what how you will be funding all of your goals. It shows your return, investment earnings at that point, as well as the ending portfolio all the way down to the very end of your plan as well too. And it shows everything that will fully be accomplished with your plan. So I want to take this time and thank you both, Rick and Darla, for allowing me to help you guys out with your retirement goals. It has been a pleasure and an honor to work with you guys. You've been wonderful, wonderful clients. I'm going to continue to build this portfolio with you guys and making sure that we stay on track to meet all of your goals. And again, thank you guys so much for deciding to reach out for my services. And until our next meeting, it's been a pleasure. Thank you again.